Peter Lynch has been one of the greatest investors in history, achieving a 29% annual return in the fund he managed, outperforming the S&P 500 index. We will review his biography and the strategy that led him to become a legend in the world of investments and finance. Peter Lynch was born on January 19, 1944, in an upper-middle-class family in the city of Massachusetts. When he was only 10 years old, his father Thomas Lynch died of cancer. Due to this family tragedy, Peter's mother, who was a housewife, was forced to work full-time, leaving the family somewhat alone, and even with his mother's efforts, the high household expenses forced Peter to work from a very young age. At just 14 years old, Peter got a job. One of the few opportunities he managed to obtain was a job as a caddy at one of the most important clubs in Massachusetts. Although this job seemed like a punishment for a teenager with other aspirations, it was an activity that would mark his life forever. Thanks to his closeness to important businessmen and entrepreneurs, he managed to listen to conversations related to stocks, the stock market, and investments, generating in young Peter the curiosity to try to learn more about investment and finance. Peter was part of the United States Army for 2 years, where he strengthened his strong character and discipline. Contrary to popular belief, Peter did not study finance or economics. His degree was in psychology, philosophy, and history, which he studied at the prestigious Boston College, where he managed to obtain his degree as one of the best in his class in 1965. Later, he obtained an MBA in business administration from Wharton College. While still a student at university, in his second year, he made his first investment in the stock market, buying a small number of shares in the logistics company Flying Tiger Airlines. The investment was 100 shares in total, with a purchase price of $8. But from the beginning, his talent for investments and the stock market was evident, as in his first operation he managed to invest in a company where he managed to multiply the investment by 10 times, as he managed to sell the shares for a price of $80 just a short time after the purchase. This operation of buying and selling shares allowed him to gather some funds to help pay part of his studies at the university. Thanks to his work as a caddy, he managed to meet one of the directors of the Fidelity Fund, Mr. George Sullivan, who allowed him to have his first job in the investment sector as an intern between 1967 and 1969. At the prestigious investment fund, he analyzed companies in the chemical, publishing, and paper manufacturing and production sectors. Thanks to his extraordinary results as a market analyst, he achieved a permanent position in the Fidelity Investment Fund, rising rapidly through the company's ranks due to his tremendous results as a market analyst. By 1974, he was appointed Director of Economic Research, holding that position in the fund until 1977. That year, he reached the peak of his career, as he became the person responsible for the memorable Magellan Investment Fund, at only 33 years of age. With his management of this fund, he goes down in history as one of the most important investors in the world, thanks to the fund's extraordinary performance, which achieved a return of 29.2% annually between 1977 and 1990, a milestone for the financial industry, surpassing the famous 10% average annual return achieved by funds indexed to the S&P 500 index. To give an idea of the fund's extraordinary results, a person who had invested $10,000 in 1977 in the Magellan Investment Fund would have by 1990 the not inconsiderable sum of $280,000 without any additional capital contribution. But the fund's beginnings were not entirely easy, since being little known in the market, the fund initially only managed $18 million, and when Peter took over its management, its profitability track record was not the best, even with negative results in some years. However, Peter managed to have the freedom and autonomy to make the best decisions to invest in the shares of companies that he considered had the greatest potential for appreciation, in addition to achieving adequate diversification, to make adequate risk management, consolidating one of the best investment portfolios of the time, with results that even for 13 years exceeded the profitability achieved by the great Warren Buffett, which was around 20% per year. In 1980, Peter Lynch was named by Time magazine as the #1 fund manager in the United States, and Fortune magazine named him the most successful person in his field due to his tremendous results. One of his most memorable performances was in 1987, when despite the market falling by more than 30%, he managed to have an impressive calmness in order not to liquidate positions, and years later he was able to recover the average profitability of his investments. Another of his most remembered strategies was having the ability to invest in more than 100 shares of companies called 10-bagger, or companies that multiplied their value by 10, while he was director of the Magellan Fund, among which he selected shares of companies such as General Electric, Taco Bell, Morris International, Ford Motor, Philip Morris, and Dunkin' Donuts, among others. Peter's investment strategies include focusing on investing in companies that are easy to understand, but taking the analysis to a high level of depth, knowing their business models and their fundamentals, trying to identify companies that offer products with inelastic demand, which are those that depend little on the price of the goods or products, to achieve profits and their growth. Peter Lynch was able to invest without being carried away by market trends or fashions, which can be fleeting and lead to the creation of speculative bubbles that burst at any time, leading investors to huge losses. Similarly, Peter's investment philosophy focused on searching for companies with high growth potential, but with solid finances, low debt, and excellent management. For this, Peter reviewed some indicators or ratios such as the PER multiple, which is the relationship between the share price and profits, to avoid buying overvalued companies or those with absurd values. Peter explains how the market is overvalued when you can't easily find stocks at reasonable prices or that meet most investment criteria. Peter also suggests taking into account expected profitability and growth, as it allows for future profit growth, which allows for a greater appreciation of the company's shares. To identify these companies, Peter investigated the company's business model and the sector in which they operated, compared the companies with their competitors and potential rivals, and reviewed multiples such as the famous PEG ratio, price-to-earnings growth, which allows for observing the growth in a company's profits. This ratio or multiple was designed by Peter himself. Peter explained how low-growth companies have growth rates that are similar to the growth of the United States GDP, which corresponds on average to 3% per year. On the contrary, high-growth companies grow quite quickly, even between 20% and 30% per year, with a practically exponential increase in profits. It was in these high-growth companies that Peter was able to identify the so-called 10-baggers, or companies that multiplied their value by 10 times. Thanks to his extraordinary ability to identify opportunities, he was able to invest in 40 baggers, or even 200 baggers, which multiplied their value by 200 times. Achieving one or two positions in companies with these characteristics can justify an entire career of market analysis. However, one must not forget the risk, since small companies that have a high growth can even disappear, bringing the value of their shares to zero. But Peter also kept some companies in his portfolio that were considered stable, since they allowed him to have a certain protection of the portfolio in times of market turbulence and in recessions, where the price falls of some growth stocks can even be double digits. Some of the stable companies that Peter invested in at the time were Bristol-Myers, Kellogg, Coca-Cola, Ralston Purina, and Procter & Gamble. Peter also identified some companies as cyclical, in which profits rise and fall regularly in line with the cycles of the economy. Cyclical companies include, for example, automobile and airline manufacturers, as well as steel and tire manufacturers. Peter explained how if you bought shares in these companies at the top of the cycle and entered a recession, you could quickly lose as much as 50%, and it would take a few years to recover the value of the stock price of these companies. Peter explained how ratios such as the PER, or the relationship of a company's profits to the value of a share, vary depending on the type of company. Low-growth companies have low PER values. For example, energy companies have a PER ratio of between 7 and 9 times. Solid, average growth companies tend to have multiples between 10 and 14 times, while high-growth companies can have a PER multiple of more than 20 times. However, before investing in a company, it is essential to review the behavior of the PER ratio over several years to have a view of what its average or standard value is, understanding that new companies have a fairly limited history of reviewing it. It should be noted that interest rates have an impact on the PER multiples paid in the market, since when interest rates are low, investors tend to pay higher multiples, while bonds are less attractive. On the contrary, when interest rates tend to rise, the average PER multiple paid in the market is lower, since many investors prefer to avoid risks and achieve a moderately acceptable return by investing in fixed-income bonds. Another element that he carried out in his analysis was the review of the historical trajectory of the company to evaluate its debt levels, in addition to identifying the solidity and stability of the annual benefits. Peter also took into account the historical dividends that the companies delivered, and he even went so far as to favor companies that had managed to deliver increasing dividends to shareholders for more than 20 years. Peter also checked whether the people who work in the company were buying shares in the company, since that simple fact was an excellent sign to expect that the shares were doing well and that the company would not go bankrupt in the coming months. If those inside the company increase their positions, it is likely that the shares are cheap and could rise. Another element that Peter considered when selecting shares was that the company was buying back shares, since it was a simple way to observe that the company itself had confidence in its future, in addition to being one of the best strategies to reward current shareholders. In addition, share buybacks reduce the number of shares outstanding, which has a direct impact on earnings per share, which can positively affect the share price in the medium term. Likewise, Peter believed that what gives value to a company are its profits and assets, but mainly its profits. However, it must be taken into account that it may happen that for long periods of time the share price is not in line with the value of the company, even leading to long periods of time where people may have doubts about whether at some point the share price will recover. However, in the long term, the value of the company ends up prevailing, as long as the company is well managed and maintains its competitive advantage. To manage risk, Peter sought to have adequate diversification, which was not excessive, because when you have too many companies, it is possible that the potential profitability of the investments will be negatively affected. These elements allowed Peter to make investments in companies with a long-term horizon, considering that his positions required a level of patience to withstand market declines, which are natural and cannot lead to despair and the sale of shares, reacting emotionally to the natural fluctuations of the markets. Peter explained how people do not have the patience to get rich slowly. On the contrary, they tend to go bankrupt quickly. Peter considered that stocks are easily predictable in periods of 20 years, but are highly unpredictable in periods of 2 or 3 years, this without considering current investors who are not able to hold a position even for a few months. On the other hand, Peter believed that contrary to popular belief, individual investors do have the ability to obtain excellent returns and results if they invest in companies that they understand, and if they study their fundamentals and the business models of the sector in which they operate. However, Peter, like any investor, made some mistakes, perhaps the most notable of which was missing out on Apple's growth. He claimed that it was not so difficult to analyze, since it was not a complicated company and had a good balance sheet. Peter remembered that his daughter had bought an iPod for $250, and at the time he thought that the company was making a good profit margin. But contrary to his usual instinct for selecting good companies, he let the opportunity pass and did not invest in Apple shares. On the contrary, Warren Buffett did see the potential and took advantage of the company's growth and its benefits for a long time. The Magellan Investment Fund and its excellent profitability positioned Peter Lynch as one of the great super investors of all time. By 1990, Peter managed assets worth more than $14 billion, with stakes in more than 1,000 companies in different sectors. But an excessive workload and a high level of stress led Peter to announce his retirement from the Magellan Fund at the height of his career as an investment director at just 46 years of age. From that moment on, he decided to dedicate himself to managing his personal funds, which were estimated at the time to be around $450 million. Also relevant to Peter's story is the publication of 3 books that are references for investors and market analysts. The first was the bestseller, One Step Ahead of Wall Street, published in 1989. The second work was published in 1994, entitled Beating the Market, and the third was published in 1995 together with John Rothschild, entitled Learn to Win. Additionally, he has dedicated himself to different philanthropic tasks through foundations that contribute to the education, culture, and scientific development sectors. Among his most renowned philanthropic works is the donation of $1 million to Boston College. In 1999, the university in gratitude named its education faculty as the Peter College of Education. In 2010, Peter made another donation of $20 million to the university for the creation of the Peter Leadership Academy. Without a doubt, his investment strategies are a reference even today for all those who seek an investment philosophy with a mix of fundamental and technical elements. In the description of the video, you will find the best course to learn how to invest in stocks and the stock market, as well as one of the platforms to invest in stocks regulated in the United States and the Patreon account, in case you want to support us to create more content.